Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, August 21st, 2017. I was putting together a market wrap today. Not a whole lot going on. Broad markets were essentially flat. We may have a breakdown occurring in the semis. I want to see a little bit more, and I'll follow up with those either later tonight or probably tomorrow on that. We'll see what happens. Like I said, I think everybody in the States here was probably out watching the eclipse or somehow preoccupied with that. So it was a go nowhere day for the markets. What stands out to me right now, and going over the charts tonight, really stands out to me are the casino stocks. Over the years, we've had quite a few, a lot more successful than unsuccessful trades there. Our ratio has been really good, and more importantly, the gains in trading these stocks, my experience has been these are usually well into the double digits, the profit potential on these trades, because these stocks really move, whether it's long or short, whether it trends up or down. So let me point out what I see. We'll dive into the charts. I'm going to start with this. This is the in TC2000, the charting platform. They use IX 1410, which is resorts and casinos. I'll follow up next with BJK, which is an ETF for those of you that prefer the relative safety via diversification by going long or short an ETF. You don't have to worry about any one company having a big gap up against your position because any losses are mitigated by the rest of the positions in there. Now, with that being said, for the most part, we're past earnings season. We're definitely past the thick of it. Now, there's always companies that report. There's always companies reporting all the time, but most companies have reported. I have not scrubbed these individual names for earnings, but I do recommend it if you take individual stocks. Have an idea when your position reports, especially so you don't take it right before an earnings report and then the position gaps against you from the get-go. All right, with that being said, here's what I see. We have a trend line off the 2016 lows back in January, pretty well. You have a couple reactions back here, almost a reaction there, very close, couple reactions there, and most recently. Um, when I dig down in the charts, what I see, what stands out to me is this: we had a what may prove to be a false breakout or failed breakout. Um, we need a little bit more downside to really say that with conviction, and if so, those are pretty high probability sell signals. Now, what I'm referring to is this level back here at the time, it's about 2,500 or so, was resistance. There were numerous taps up against that level. Here, we can zoom in even more. Excuse me. All right, so we can look at that level. We can see we had quite a bit of pushing up, test, test, boom, and then a big breakaway gap. This candle right there, that big green candle, that occurred in a gap. So we broke above resistance. And what happened from there? I'll draw a little line. That breakout to new highs, we didn't go very far percentage-wise, at least relative for the casinos. It might have been a couple, 5 or 6 percentage points. I didn't measure it out. Maybe a decent move. However, it was not what you would expect for a breakout to new highs. Um, and the reason is, when you go long, when I'm looking to go long a stock, I'm looking for either a well-defined chart pattern, a well-defined resistance level, might be a downtrend line, might be horizontal price resistance, and you look for a breakout, you look for impulsive price action. So that's everything. They got the breakout, they had the impulsive price action. However, the follow through was lackluster, and then we came back in. Now that in itself is normal, but what had, and I may have pointed, no, not at the time. I don't think last time I pointed these out was back right before the correction back here in 2016. But personally, I don't take breakouts that are with a security that's both overbought, overextended. You can see these extreme overbought readings on the RSI, and we had negative divergence. That high was a divergent high, hence the correction. So whoever chased that breakout gave back 100% of their profits and then some, and I doubt that made, for the risk that you take on these on the downside, I don't think that gain was worth it. If the top of that candle, they only went up another 4% or so. So you came back in. And now that in itself isn't so bad because breakouts to new highs or any breakout is very often back tested. So some healthy price action would have been to have seen a successful back test of the former resistance, now support level, and then boom, off to the races. So number one, we didn't see that. That gives me a little pause on that breakout. We came back in and I put another line there, right perfect to that gap. You see the breakaway gap where the crosshairs are? That's where we back tested and then we rallied. Now, if this was a healthy breakout and there was a lot of pent up demand in the sector, um, and these companies weren't overvalued or didn't have some issues, you would have seen this take off, and more than likely, we would have already cleared that previous reaction high. And what happened is we fell short. So from that breakout, we had that previous high after the breakout, and so far we fell short of that, and we came back in and made even a lower low so far. So if you look at it this way, let me draw it another way for you. Essentially, since that breakout, since it peaked, we've been in a downtrend. Prices have been making a series of lower highs as well as lower lows. Um, can't write this one off yet. This may simply be a correction in time, not so much in price. We didn't fall that much. We're corrected sideways in time, but everything that I see in the charts, I see that divergent high. I can see the PPO. A lot of trend indicators are pointed down. They're below the zero line, and I see a pretty extended uptrend line. And I can just tell you, we don't have that sell signal yet, but it's very close. Very close. And what I'm referring to is a break of both those intersecting support levels, the uptrend line support as well as that horizontal level there around 25. I think that would be a pretty high probability sell signal. Now let's look at BJK, which is more of a pure play here. It's a gaming ETF. And you can see the chart will look almost identical. This is the primary uptrend line. Here's that support level right here. We came in and back tested it recently. So again, all eyes, or at least my eyes, are on these intersecting levels. Now, prices are a little bit above its trend line's a little bit above support now. So one possibility is we may come in, break down the yellow trend line, back test, a kickback rally. Either way, it's hard to predict in the very near term where things are going. I'll have to zero in on the 60-minute charts of not just BJK, but all the components. But I think there's a good chance this one goes down here, at least this far, and that's about an 11% drop from where we're at. Um, on this chart, this is a 2-year daily chart. You can see this bearish rising wedge right here, breakdown, back test, and now we're down to that trend line. Right here, we had the same type of divergence. You see negative divergence. In fact, it was back in October where I was getting bearish on these casino stocks. And just to give you an idea, and remember this is just an ETF, that was good for about 11, almost an 11, yeah, about an 11% drop. Now, what happened? We had a divergent high there. Prices came in a little bit, pushed up one last thrust. This looks like a stop clearing, short covering run, and that proved to be the top before that 11% drop. So, like I say, these things fall quick, and that was just in a few weeks. And again, that was on an ETF, not an individual stock. I'm sure there were plenty of names out there that fell 20% or more. So we've come full circle. Another divergent high. These are what I look for: divergent highs and lows. Go long on the divergent lows. You go back. This is a 10-year weekly chart of BJK. We had the meltdown in 2008. A little counter trend rally down towards the low, and that final thrust down. The broad market also went down in the March 2009 lows. Very strong, powerful, positive divergence. This is where you look to position long for trend trades, trades lasting not just days or weeks, but trades lasting months. So we're looking at, again, a weekly chart here. And this weekly chart shows you had the divergent low followed by well, typically, basically the entire bull market there, about 400, 390% run. But even within there in these smaller, forget about the secular trend or the big macro trend. You had these smaller trends. You had a rising wedge type pattern, steep negative divergence, and although it might not look like much on here, I just have to grab next to that where the prices were. That was a 31% drop right there. So again, you can trade even within a bull market. You can trade short, just like you can profit trading long within a bear market on the counter trend rallies because they're very powerful, especially when using these weekly time frames. Because this, again, if I'm trading any type of chart pattern off the weeklies, that is a trade that is at least 5, 6 weeks, if not 5, 6 months or more, and in some cases years. So that's what you're looking for. So what happened here? We had a nice, well-defined uptrend line, extreme overbought conditions at the top back in 2014, early 2014, and so far, the gaming sector has been in a clear bear market since then. So, like I say, forget about the broad markets and trading the S&P 500. You're trading too many good sectors with bad. Sniff out the most bullish and bearish sectors within the economy. commodities, other asset classes, and trade those long and short. It's a way to diversify and boost your returns. So this one, we broke that trend line. We're extremely overbought. We fell back down into those 2016 lows, and we had strong positive divergence there, bullish divergence. This was a price channel right here. You can see the positive divergence at the lows, and from there we rallied. What has it been, 52% or so? And this is a large rising wedge. It's well defined. You can see the uptrend line. Um, it's a wedge pattern. We reached extreme overbought levels, haven't been seen since that top back in late 2013, early 2014. PPO is pointing down, and this just kind of gives me the bigger picture. If and when this trend line breaks, which I think it'll be sooner than later, we'll see. We'll know soon enough. Um, you know, there's a lot of downside targets, but that would be a minimum target right there on the weekly chart, about 34.65, and that's about a 12% drop. So let's just say at this time that's all I'm looking for in BGK, about a 12. Now, I told you I love to see intersecting support and resistance levels to trigger buy or sell signals when those are taken out. Even as much as that, I should say, I also love to see confirming overlapping bullish or bearish chart patterns. That's also a great sign. So what we have here, I've just flipped to another board on BGK. Um, we have a nice, clean looking head and shoulders topping pattern. If you're not familiar with those, I recommend Google the term. When you look at head and shoulders patterns, they sometimes have a flat neckline, meaning this is the neckline here, NL neckline connects this is the left shoulder, the head, and the right shoulder, just like a human body. You got the shoulders and the head. Now those necklines can be flat, they can be upsloping or downsloping. In this case, we have an upsloping neckline. And I also had that longer term uptrend line I showed you that's not drawn here. Well, we can put it there just for now, just so you recall that we have now this level here, we have this level, we had a horizontal support level. So there's a lot to be taken out here if the gaming sector drops another just a few percentage points. I think it's about another 3% or so. Now, looking at that first chart we were on, I would say wait for a break of the trend line and that horizontal support level. When I look at this chart, I can say that if you wanted to get a head start, a more favorable entry, like I said, it's going to be another at least 3% or so before we take out that support level down below. Clearly take that out. This is a breakdown. It's impulsive. You can see the two big red candles after the neckline broke. We saw a back test of the neckline, and this is technical analysis 101. You short either on a break of support or the chart pattern, in this case the neckline, that's what triggers a sell signal on a head and shoulders, or you can wait and either short or add to your position on a back test of the neckline, because that should then become resistance. And so far it has. We rolled off it, and we're barely off it now. So again, an aggressive entry, or even not so aggressive, it's a pretty low risk if you're stopped out, because we're so close. The neckline's only, less than 2% above. So you could go short BJK here. You also have a nice support level. As I look at this chart up closely, see this gap right here? There's a gap. In that bottom of the gap, I put that line, and then there you go to the left, you see a lot of reactions from above. That was support. Then we gap down below there. So this line here, let me give you the number, 4038. That is an objective stop point, just a little bit. I always give a little bit of room. The market makers, they know what people do with TA. This is not anything new. If you're watching this on technical analysis and your stop is at, because that level's at 4038, and you put your stop at 4040 and they make a run for it, they're going to clear you out. There's probably thousands of stops sitting right above there. So you put it a little bit above, or you wait for a solid daily close above. That's at least what I like to do. So that's an objective entry now. And what I've done here is I've taken the measured target for the pattern. If you take the widest point from the head down to the neckline, which I've done here with this trend line, and simply add it to where prices broke down, and this I tell you never fails to amaze me. When I take the measured move of a technical chart pattern, and I didn't try to make this up, I just measured that line as I showed you, I put it to where it broke down, and that comes exactly where I had previously placed my target, just looking at this chart. I see a gap right here. I see reaction highs. That level I would have been targeting even if I didn't point out this head, or didn't see this head and shoulders pattern. And that happens to be, coincidentally or not, exactly where that pattern projects to. So what is that in percentage terms? If you short where we're at now, again, the market's closed. We'll have to see what happens tomorrow. That is a drop of about 5.6%. Not bad, but remember, I also think that that opens the door up for a bigger move down. I think there's, more downside in the gaming sector. All right, let's look at the individual stocks. I'll go through those a little bit quicker. Let's pull back up IX 1410. That gives me a watch list here, related items. You can see all the gaming stocks, resorts and casinos. I have it sorted by market cap. I won't go into everyone here at the bottom. I'm just going to run through some of the big names. The bigger names are more liquid, and that means you can get a better, more favorable entry. You don't have to worry about the spreads being wide or getting filled. So you short a company like Las Vegas. Las Vegas Sands is almost a $48 billion company, so plenty of liquidity there. Just a beautiful looking chart. We had a divergent high here. I believe I did point that out back in October. We had a breakdown of the trend line, a back test, and boom, it dropped. And let me have to move that trend line to use my measuring tool. And that was a 18% drop. So there's my point being made that about the individual names. That was a clearly bearish pattern. I pointed out at the time, and it fell down there. Now what's happened is that correction, as big as it was, only was an extension of the existing divergences. We had negative divergences at that point. Everything's not always drawn out on this chart. There's the second divergent high. It steepened at that point. So we had divergence, and now the divergence that was in place back then, we've just continued to extend those divergences. We're making roughly equal highs on the RSI, a lower high on the PPO, and this is just another even larger rising wedge pattern we just broke down and back tested. So at minimum, I think we're coming back here to 56.35. And the beautiful thing is when I take a step out to the longer term, the weekly charts, you got to almost roll. I'll scroll away and exclude the meltdown in 2008-9. It distorts the charts. You can see here, as I said, it's wash, rinse, repeat. I look for these big divergent highs. I mean, these are divergences that spanned over a year or more. And you can see them marked with prices making higher highs, the indicators making lower highs. And back then it was, hate the fact that I highlight and it moves the tools. I'll have to just jump over here to another board. And just again, to give you an idea of the gain potential on these stocks, 44, almost a 45% drop. Um, we had a big top here, was extremely overbought, fell down in this big bullish falling wedge pattern with these two orange lines, confirmed with positive divergence at the lows, and that led to that divergent low was good for a rally so far from bottom to top of about 88%. So the point I'm trying to impress is these weekly charts really set up the trend trades. If you've got the gumption to ride out all these counter trend rips, and how do you do it? Well, you get in if you can identify a top or bottom. And I know sometimes you get cut when you're trying to catch a falling knife, but if you can get it right, we break down here. You set a stop not far above the recent highs or wherever you want to set it, and you let your profits run. And you can either strategically reduce, take some profits at major inflection points. For example, when the 60-minute chart set up bullish or the daily charts, you can reduce, cover your shorts, maybe get back in, or just set your stops and let it ride. Because again, the gain potential in these stocks is huge. Now, fast forward to today. This is just a beautiful, clean, bearish rising wedge pattern. I'm referring to this upper trend line here that shows the divergence, and this trend line down below. This is our uptrend line. We're starting to crack below it. There's also some horizontal support there on Las Vegas Sands as well. You can see how steep the divergences are. Again, I had to roll in, get away from the 2008, 2009 meltdown there. Makes the scaling on the chart all funky. But this is a clean looking, nice looking setup with a lot of meat on the bone. All right, I'll go through these a little faster. This is MGM up next. We're still on a weekly time frame. I zoomed in a little bit to get rid of the meltdown. And just you can see a very large multi-year divergent high, followed by a smaller divergent high. Some of you might say, well, those divergences are so long they don't matter. They do. They do in my opinion, my book. But if you're looking for, you know, divergences that only span, months, you have that divergent high right here. You can see the white line. So they mark the steeper divergences here. There's your uptrend line. Daily chart. Here's MGM on a daily chart. This bearish rising wedge was pointed out here back in October. Broke down. We danced along support, and then we hit the two targets that I had. I think I covered those in a video or static post. I can't recall. You can check that on the site. Um, Came down, hit this final support level, and that was a pretty decent drop in MGM. And remember, these are multi-billion-dollar companies, and they were still good for 17% drops. Now we see very clear negative divergence here. We went up, we had a divergent high there, we corrected, um, and that was a drop of about 12 or so percent. We rallied right back up, made a marginal new high, and then boom, fell down again. That's bearish. We took out, we had that correction. That did not clear out the excesses in the stock. We fell back down. Now we're sitting on a very key level on MGM, in my opinion. And again, where this analysis ties in, if you're going to just trade the ETF, it's good to watch these big leading companies. These are the big mega casinos, the Las Vegas Sands, MGM, Wynn. Those big three alone are the majority of the market cap within that ETF. So there it is. That was your previous high. You could see we failed, couldn't get through. Finally, we broke out and we back tested once. Should have been off to the races, but we weren't. We're right back here again. And we had divergence not just at this high, we had negative divergence here. That's some pretty large divergence. There's your sell signal and a solid break, especially a daily or even a weekly close below 3010. Where does it bring us to? Over time, I believe down here, about that former target 2581, the actual support levels here. I think we go down to those lows, 25. So you're looking at a drop of roughly 18%. And again, that correlates really with what I'm expecting in the sector. Said and done. If you're trying to swing trade it and you're willing to ride out the bumps, that's where I think the drop in the casino stocks will be somewhere around 18%. Win is setting up into this is called a right-angled and descending broadening formation pattern. Fancy word for that type of pattern, but that's what these two lines indicate. So we had a price channel here. It was a slightly contracting, slight wedging type price channel. We had divergence there at the highs. You can see the negative divergence, and it started to play out, but like I said, the casino sector, as I started out in the video, is correcting more so far in time than in price. And I will say this, that if they can't break it down, if we don't break those levels, we have some of the key stocks as well as the sector sitting on some key levels. Maybe that's it, and maybe these guys continue on up. That looks pretty expensive. There's a P ratio right there, a 50 P ratio on Win, into an aging bull market with, divergences all over the place. Not so much right now. We have an overbought reading. Last time we were overbought was back here at this level, and you can see what happened. You go back here, this was in the early stages of the bull market. We had persistent overbought readings. But, if you're of the mindset that the casinos, and it's hard to argue otherwise, have entered a new secular bear market, so far that's all it is because they're well off their highs. So if so, this is a counter trend rally with more downside to come. But again, let's take that as it comes. I'll run through the rest of these a little faster, and you can just pick some of your favorites. Like I said, I like them all. MLCO, very nice uptrend line here, this orange uptrend line. So a lot like many of the other charts, including the sector. You see a break of this trend line, then you have a pretty important support level just below it. That support level is defined by these previous reaction highs to the left of the chart, and so that one could fall quite a bit if it breaks both these levels. MTN, Vail Resorts, we have a couple trend lines here. I have what I call a primary. I'm going to jump out to a 2-day chart. This spans 4 years. Each candlestick is 2 days. You can see this trend line comes all the way off the mid 2014 lows, pretty well defined, and that's a trend line I expect to be visited. So let's zoom back into the daily chart. This takes us down to 2 years. What I see, so that's the primary uptrend line. Within that primary uptrend, I see rallies that get stretched. They get away from that trend line. In this case, we set up in a bearish rising wedge pattern. We broke down and we corrected sideways for a while. Then we hit and formed this new uptrend line. You can see it's pretty well defined. At this point, we now have a divergent high. You can see I'll draw it out here. It's wedging up just as we had divergence back here. So a sell signal would come on a break of this trend line, and my initial swing target would be this primary uptrend line. And that's probably, I'd put a pretty good odds, very good odds on a reaction off that trend line. But depending on how the sector looks at that point in time, I may look to position for another thrust down to any of these targets. Here's MTN or Vail Resorts on a long-term 10-year weekly chart. You can just see that uptrend line. Um, this is getting pretty extended. These stocks are all getting overvalued. Um, Nosebleed levels. They have these key bull market uptrend lines. Like I said, a lot of them have already failed that, and they're in they've been in downtrends. They peaked back in 2014. There's some names like Vail Resorts that haven't, and I don't know the specifics of Vail Resorts, how much of their revenue is derived from gaming, or every casino is different. Depends on the state you're in and the economy and everything else. So let's just go on to the next one. Go a little quicker here. HGV, I don't see a lot there that stands out to me, so I won't spend time on it. VAC, this is Marriott Vacations Worldwide, obviously resorts. You can see there, nice trend line break. It was in a big wedge pattern, and had a healthy correction from top to bottom. I just have to go to the left here to measure. That was about a 26% drop right there from this peak to this. Now we have a very well defined uptrend line terminating in a rising wedge pattern. You can see confirmed with negative divergence and a breakdown. We've hit our first support level. This would have been my first target had I shorted there. I'm looking at it now. I didn't, but I'm looking for a break of this level here, and that's about 108.90 or so, and that should take us down to 95.50. So just doing the rough math, that's about a 10% drop. Next stop be about 90, 91 or so, and ultimately I think this one works its way down here to about $80. So from 110 to 80, that's a pretty healthy drop. If you ride it all the way down, that'd be about a 27% drop. There's Boyd Gaming, BYD, Divergent High. I don't have this one marked up, but I do. Well, I do can tell you this. I looked at this chart. 2136 would be my swing target. You'd have a little reaction here along the way at about 2450, 2440, more than likely. If you do, that'll probably set up this broadening wedge pattern, and then you look for a downside break of that, and it's probably going down here to 2136. So, you want to take a shot at it here. I don't see an objective entry, I have to be honest with you, but I think if the sector goes down, birds of a feather flock together. This one's coming down, and from there, that's about an 18% drop. So again, there's my 18% number. It's not random or arbitrary. It's set on where the likely projections where the key resistance levels are or support levels below. CACQ, Caesars, this is Caesars Acquisition Company. Beautiful chart. Look at this wedge pattern. You have a very super well-defined uptrend line. Just look at all the reactions on this uptrend line. You have you had within there a smaller wedge. See the yellow lines, a little wedge breakdown. It had a little correction, but now you have this much larger wedge. You had a divergent high at this point. You started to correct, like a lot of the other stocks in the sector, thrust it up to one last marginal new high and has since rolled over, broken down below the trend line. We're already dropped about, I didn't even get the full thing there, about 12%, 13%, but I see a lot more downside. We need to take out that $18 level. If so, we're probably going down here to about 15.46. That's about a 14% drop. And my preferred swing target right now at this time is down here. That's about a 24% drop. Yeah, I'll give you the number there if you're interested. I'll get it out as an official trade idea. 1356. And over time, I can easily see here's a support zone. So this is my if things get ugly target right here. This support zone right here between $11 and we'll call it between $10 and $11. That's my, if things get ugly in the sector target. Weekly chart, I didn't mark it up, so let's just jump off it. RRR, triple R, Red Rock Resorts. Looks like a big level that it has here. You can see a lot of reactions along this level. You had divergent high. You can see the negative divergence here at that peak. You can see similar wedge type pattern, rising wedge, breakdown, back test, and boom, a drop down. Now, it's not objective to short here because A, we just had a drop of about 14% or so, and more importantly, we're coming up on support. So if nothing else, this one's due for an oversold bounce, maybe a consolidation. But if and when that level goes, that's longer term bearish. That's a very important support level. Penn National Gaming, nice uptrend line, well defined. This yellow line here, we just broke through it. We broke through it impulsively. You can see the impulsive selling so far. And the two white lines, that shows an ascending broadening wedge pattern, which we've also now broken through. So this one looks good to go. Again, I'd like a little more confirmation in the sector. I may start scaling into some positions. Um, we'll watch how these trade over the next week or so. But like I said, I wanted to get these out for you guys so you have all these setups good to go in case things start to really get exciting in the market soon. Minimum target down here is about $19. So we're at 20 right now, 2031 that is. So let's say we take out that level, it's about 2017, call it 2015 to be safe. You're looking for a drop down to 19. That's pretty good to get a point on a $20 stock. I'll take that all day long. LQ, La Quinta Holdings, bearish rising wedge pattern, negative divergence, beautiful chart. These are levels. This is my preferred target down here, 1305, which would represent a drop of 15.5% if hit. Caesars Entertainment, CZR. I have multiple trend lines. I can use this white up trend line off the low, which I think is the more valid of the two. I'll show you on a weekly chart in a second. You can see the divergent high, negative divergence, bearish rising wedge, and I don't know if you can make out down below. I put the word buying climax with a question mark because this looks like a buying climax. When you see a rise up like that, a surge, a huge volume surge, it's, well, as the name implies, a buying climax. That's about it. That's pretty much a top, at least for some period of time in the stock. And so we've already broken what I consider the most important trend line. Once this one goes, I think the nail's in the coffin. Here's a weekly chart. Excuse me. Uptrend line broken. That's that white uptrend line I had on the daily. Oversold, very oversold. In fact, we haven't been that oversold since back in 2013 when we had this divergent high here, and from there the stock dropped a mere 87%. So again, high returns on these stocks, and that goes hand in hand. You know, the losses can be pretty painful too. So just pick your stops and stick with it. ERI, Eldorado Holdings, divergent high here, divergent high here. Each one had a correction. Now another divergent high right here. I didn't mark it on the chart. You see an extension. So this is what I call really an extension. These are all smaller divergent highs within a larger series of consecutive divergent highs. This one has a lot of meat on the bone. This one will go down. We hit last time my target is 1749. I think we'll hit it again. That's a 21, about a 22, actually 22% drop. And I think this time, last time we didn't hit my second target of 1545, and I think we do, and that's about 31% or so lower. One of my favorites right there. Playa, nothing. Now we're getting down into the smaller cap companies. So I'll just show you the charts. If anything stands out to me, I don't see anything on every single chart. Some charts just aren't, it's not there. PNK support right there, 1880. Once that level goes, stock goes, PPO is in bearish territory. It's turning back down. We had this rising wedge breakdown, impulsive move down, came to test this longer term uptrend line, the primary uptrend line. We've broken that. So again, 1880, this one goes down. NNY and NYNY, I'm sorry, Empire. This is Empire Resorts. There it is. Negative divergence. You can see there. Negative divergence. Confirming the rising wedge. We need to break this trend line there. MCRI. Rising wedge. Breakdown. Strong kickback. Stop clearing run. Just put in another larger, more powerful divergent high. We're going to come down, in my opinion, to this trend line here. I mean, the support level, it's about 20, we'll call it 29. It's actually about 28.38 or so. Well, let's just say to be safe, I'll put another line here. If you wanted to cover, not try to fish every last penny, this is where I'd cover on this one. 29.50. Pace, nothing there. CNTY, breakdown, and FLL. These are getting really small now. Full House Resorts, but nice divergent high. coming down to these intersecting trend lines support and horizontal support. That's about a 15% drop. And last one is UWN, Nevada Gold and Casinos. Breakdown, back test, and I think ultimately probably come down here to that 219 level, but that's low price. Be careful with those low price names. But anyways, that's my take on the sector. This video was pretty long, but I covered a lot of names, and I hope you guys enjoy and profit from them. This has been Randy Finney with Right Side of the Chart.